Most people who bought a rental property last year did not have a lot of money when they started. That is not an inspirational statement. It is just true, and it matters, because the story we're usually told about real estate is one that begins with a fat down payment, a stable income, and a banker who actually calls you back. But the majority of first-time landlords in this country did not follow that script. They found cracks in the system, small ones, legal ones, and they used them. This video is about those cracks, not the motivational version, not the seminar version, the actual mechanics. What works, what costs you more than you think, and why $25,000, used correctly, can get you into a real income-producing property in 2024. Let's start with the thing nobody says out loud. Real estate has a perception problem. When most people picture a rental property, they picture a landlord who already owns 4 of them. Someone who uses words like portfolio and passive income in the same breath and means both literally. Someone who got in early. Someone who is not you. That image is partly true and mostly misleading. Yes, the wealthy own a disproportionate share of American rental housing that is documented, that is real, and that creates real market distortions. But the mechanism that allows them to own more is the same mechanism available to anyone willing to understand it. It is called leverage, and we will get to it in a minute. First, let us talk about where you actually are financially. $25,000. That is not nothing. It is also not enough to outright buy a rental property in most American cities. The median home price in the United States right now hovers somewhere around $400,000. A traditional 20% down payment on that is $80,000. So by conventional logic, you are still $55,000 short of even sitting down at the table. Except conventional logic, in this case, is wrong, because there are at least 4 well-established, widely used pathways into rental real estate that do not require a full conventional down payment, and one of them, if executed right, requires almost no down payment at all. Pathway 1. House hacking. The first pathway is the one that almost nobody talks about in the flashy YouTube real estate world because it is boring and slow, and it works. It is called house hacking. Here is how it functions. You buy a 2, 3, or 4 unit residential property. You move into one unit. You rent out the other units. Your tenants pay most or all of your mortgage. You live essentially for free while building equity and generating rental income. The reason this matters when we are talking about $25,000 is the loan type. When you purchase a property as your primary residence, you qualify for a very different set of mortgage products than when you purchase a pure investment property. We are talking about FHA loans, which require as little as 3.5% down. We are talking about conventional primary residence loans that go as low as 5% down. And we are talking about loan limits that, depending on your market, can reach into the $400,000 and $500,000 range. You are now the owner of a 2-unit property. You live in one side. The tenant in the other side pays you rent. Depending on the market, that rent might cover 60, 80, or in some cases 100% of your total mortgage payment. That is the boring version. It works. It has worked for decades. Pathway 2, the BRRRR method. The second pathway is slightly more complicated, but opens up more options if you do not want to actually live in the property. It is called the BRRR method. Buy, rehab, rent, refinance, repeat. Here is the underlying logic. Instead of buying a turnkey rental at market price, you find a distressed property, something that needs work, something that other buyers passed on because it smells like 1987, or the roof needs replacing, or the previous owner had a creative approach to plumbing. You buy it cheap. You fix it up. You rent it out. Then you take it back to the bank, which now sees a renovated, tenanted, cash-flowing property instead of a wreck, and you do what is called a cash-out refinance. The bank gives you a new loan based on the higher, post-renovation value. You pull out the equity you created through your work and your capital. You use that money on the next deal. Done correctly, you can get most or all of your original cash back. Done incorrectly, you blow your budget on renovation. The market shifts, and you are stuck in a house that smells like 1987 and you. The risk is real. The carrying costs during renovation, the unpredictable scope of older properties, and the dependency on favorable appraisals all add variance to this strategy. but it is also why distressed properties in secondary markets, smaller cities, the Midwest, the South, can still make this math work when coastal markets have become entirely inaccessible to most investors. With $25,000, you are probably targeting properties in the $40,000 to $90,000 range, requiring heavy work. Rural markets, small cities, places where $25,000 in cash can still buy you real leverage. The uncomfortable truth about leverage. Now let us talk about the part that people find either exciting or genuinely unsettling, depending on their relationship with other people's money. Leverage. This is the actual engine of real estate wealth, and it is important to understand it clearly, not romantically. Leverage means borrowing money to amplify your returns. When you put $25,000 into a stock, you own $25,000 worth of stock. When that stock rises 10%, you made $2,500. Good. When you use $25,000 as a down payment on a $250,000 property, you control $250,000 in real assets. When that property appreciates 10%, you did not make $2,500. You made $25,000. Your original investment doubled on a 10% price movement. That is leverage. That is why real estate has historically been the primary vehicle for middle-class wealth accumulation in America. Now here is the part people skip. Leverage works in both directions. A 10% price decline on that same property does not cost you $2,500. It costs you $25,000. Your entire down payment, on paper, gone. This is not hypothetical. It happened to millions of Americans between 2007 and 2012. People who had done everything right, had positive cash flow, good tenants, solid neighborhoods, and still watched their equity evaporate because the broader market collapsed and they were over-leveraged. Leverage is the accelerant. It makes the gains bigger and the losses bigger. The math they do not show you. So here is the uncomfortable math that most beginner content either glosses over or saves for the end in a small font. Owning a rental property is not passive. Not at first. Maybe not ever. The advertised return on rental real estate is almost always the gross yield. That is rental income divided by purchase price, expressed as a percentage. A house that costs $100,000 and rents for $1,000 per month has a 12% gross yield. Sounds good. Now subtract expenses. The point is not to discourage you. The point is that if you run the math with honest numbers before you buy, you make a completely different set of decisions than if you run it with the optimistic numbers you found on a real estate investing forum at 11 o'clock at night. The bigger picture. Who else is playing? Let us zoom out for a moment because there's a bigger picture here that affects everything. The rental market in America right now is experiencing something genuinely unusual. Institutional investors, large private equity firms, real estate investment trusts have over the last decade bought somewhere between 3 and 5% of all single-family homes in the country. That number sounds small. In aggregate, it has had measurable effects on housing prices in specific markets, particularly mid-tier cities in the Sun Belt, where these firms concentrated their acquisitions between 2012 and 2022. What does that mean for the small investor? Two things, pulling in opposite directions. On one hand, competition for entry-level properties in desirable markets is genuinely more intense than it was 20 years ago. You are not just competing with other individual buyers. You are sometimes competing with corporate balance sheets. On the other hand, institutional investors tend to pull back sharply when interest rates rise and cap rates compress. They have done exactly that over the past 2 years. The investor share of home purchases has dropped meaningfully since 2022. That pullback has quietly opened opportunities in markets that were previously inaccessible. The window is not wide, but it is open. Pathway 3. Seller financing. There's one more strategy worth understanding. It is called seller financing or owner financing, and it is probably the most misunderstood tool in residential real estate. Here's how it works. Instead of borrowing from a bank, you negotiate directly with the property seller to act as the lender. They accept a down payment from you. You make monthly payments to them at an agreed interest rate, and they hold the note on the property until you have paid it off or refinanced with a conventional lender. Why would a seller do this? Several reasons. They might want income stream rather than a lump sum for tax purposes. They might have a property that is difficult to finance conventionally because of its condition. They might want a faster, simpler transaction than the bank approval process allows. This strategy is uncommon, which means it requires finding motivated sellers, usually through direct outreach, driving for dollars, expired listings, probate situations where a seller's needs happen to align with what you can offer. It is not a regular feature of the MLS. It is a conversation, and like most things in real estate that actually work for people with limited capital, it depends heavily on your ability to underwrite the deal, understand what you're signing, and not get taken advantage of by a seller whose property is distressed for reasons you have not fully investigated. What is actually true? So where does this leave you? Standing at the edge of this market with $25,000 and a reasonable amount of skepticism? Here is what is actually true. The first deal is always the hardest. Not because of the money, though the money matters, but because of the information asymmetry. Sellers, agents, lenders, contractors, all of them have done this many times before. You have done it 0 times. That gap is real, and it costs first-time buyers money. The best investment you can make before you spend $1 on a property is on your own education. Not courses, not masterminds, not anyone who charges you to tell you what they know. Actual education. Books, research, local market data, conversations with landlords in your target area. Time spent understanding the specific economics of specific neighborhoods in the specific city you plan to buy in. Markets are local in a way that national content, including this video, simply cannot account for. A cash-flowing duplex is a real thing in Memphis or Indianapolis or Kansas City. It is a near mythological object in San Francisco or New York. Know your market before you commit your capital. The closing question. And here is the question I want to leave you with. We have spent a generation telling people that home ownership is the foundation of financial stability, that the house you live in is your best investment, that real estate always goes up. Some of that is true some of the time, and some of it is a story that benefits people who were already in the market when the story started being told. The honest version is this. Real estate can be an extraordinarily effective tool for building long-term wealth. It can also be the thing that traps you financially for a decade if you buy the wrong property at the wrong price in the wrong market with the wrong understanding of what you are getting into. The difference between those two outcomes is not luck, and it is not capital, and it is not timing, though all three matter. The difference is how clearly you see the system you are entering. $25,000 is enough to get started. The question is whether you know enough yet to know what you are starting.